biggest questions today is, should I sell my home because of the mass appreciation, or should I keep it and should I rent it? What should I do, Jerome? It's a big question. People have been coming, asking us for the last 6 months to a year. And all of this has to do with the mass appreciation, the shortage of inventory, and with mass appreciation comes profitability if you sell your home. And so one of the big things is you may have a home that you paid $350,000 for. Now that home is now worth $500,000. That's $150,000 that's appreciated, let's say, over the last 10 years that you've owned that home. And a lot of that appreciation has come just in the last few months with the pandemic, the shortage of home inventory, and the mass appreciation of real estate, plus the expense cost appreciation of lumber and all the build costs. And so you sit back, and there's a few things that you need to be aware of before you consider selling your home. And so one of those things, one option and one thing to consider is whether you should go out and get what's called a HELOC, a home equity line of credit on your home. Maybe you keep your home and you rent your home as scenario number one. And so you have this $150,000 worth of equity. So you go in, you exercise a home equity line of credit, you get the house appraised, and you pull out $150,000. Well, after all expenses, fees, and they won't give you the full $150,000, but they might give you about $120,000. You keep your house, you lease it out, and now you take that money and you go buy yourself another home to be able to live in. So you can go out and buy, let's say, for example, a $600,000 home that you normally couldn't afford. But you take that $100,000, $120,000, now you owe $480,000 on that home. Now your mortgage might be slightly higher than it was before when you had a $350,000 home. But the house is larger, the yard is more usable, and you have a lot more space, and you scaled up, right? And so that's also an option. And so you could go in, take that home equity line of credit, and keep that money. Here's what's cool, is the second consideration that you have to take into account when you have equity in a property is what's called capital gains taxes, right? Anytime you go out, you buy a property, and it appreciates in value and you sell it, you may be subjected to what's called capital gains tax. Now, right now, capital gains tax is one of the most inexpensive taxes for gains on real estate that there is out there. In fact, you can go out there and generate an extra $250,000 in gains on your house if you keep it for over 2 years, tax-free. Now, if you're married and you're filing jointly, you can claim up to $500,000 of capital gains. So if you're in a market that has that ability, let's say you're on the coastal areas of California and you bought a house for $1 million and now that house is worth $1.5 million. And you sell that house at $1.5 million and you're a married couple and you're filing jointly, you can take that $500,000 out tax-free. Now, Biden right now is trying to double capital gains taxes, which is scary because we may land up subjected to higher tax rates, even higher than our normal income taxes with capital gains if that does happen. But if you take that equity, you've been in that house for 10 years, you could take that $150,000 of equity and be able to capitalize on that tax-free and be able to redeploy that money. So that's a consideration as well. Now, third consideration is the equity, the true equity in your house. Okay, so you sit back and you say, okay, do I keep this house? Do I rent it? Do I sell it? What do I do with this house? If you take a graph over the course of the last 100 years and you just compare real estate, you'll notice that real estate naturally appreciates over the course of time. And what they tell us year over year, our natural appreciation in real estate averages just under 5%. So if we take 5% of that, 0.05%, they're telling us that our house simply appreciates on a $500,000 house about $25,000 per year. And so if you multiply that times 5 years, that's $125,000 that your house is worth after 5 years. Okay? So 5 years, if you keep your home, you're going to have an increased value of $125,000 based on the national average of returns on real estate. Okay, this is keep. Now, if we rent the home, if we sell the house, we get $150,000 out of it. Now, how do we redeploy that? Okay, do we keep that? Do we buy more homes? What do we do to be able to make the value of that more viable. So let's say we take that same home. Let's say you can get $2,000 a month in rental income for a house of $500,000. Okay, just for sake of examples, probably a little bit low, but let's say that you have $2,000 times 12 months times 5. That's $120,000. Okay, now my recommendation is to scale down a little bit to a normal single family home. And when I say normal, I'm saying something in the average, in the mean, something between $250,000 and $350,000. This way, you have a mortgage payment of someplace in the neighborhood of about $1,200 a month to $1,500 a month, and you could rent that property for someplace in the neighborhood of about $2,000 per month. Now, if you take let's say for sake of example, you take that $120,000 and you go out and you take $150,000 out of the equity from that home. You sell that home. What if you just sell the home completely? You go out and you buy 3 homes, put $50,000 into 3 single family homes. Okay? You take that home, you sell it, you buy 3 homes that are someplace in the neighborhood of $250,000 to $300,000. Your mortgage payments are somewhere between $1,200 and $1,500 a month. You get a rental income of about $2,000 a month. Now you're making about $500 to $700 per month on average of rental income on top of your mortgage payments. Now you're also building equity. Now you got 3 homes, and each one of those 3 homes, let's say for sake of example, they're only worth $250,000. Okay? So now you take 3 homes that you bought, you sold the house, you took all your equity out of it, you're maybe living in one of them, and you have 2 other homes. But all 3 of them are appreciating. So now you take 3 homes, all 3 of them, $750,000 times 0.05. You just appreciated your income in 5 years by $375,000. So you have $750,000 worth of assets, plus in 5 years, you're going to add $375,000 to that. That's $1,125,000 that you have just in the equity of those homes. Not only do you have the equity in those homes, now you have over $1 million worth of assets, but what you also have is you have passive residual income. What is passive residual income? It's the money that you make every single month in spite of what you do for work that generates month in, month out when you have rental income. Okay? And so you can do this with commercial buildings. You can do this with single family homes. You can do this with apartment complexes. You can do this with any type of cash producing real estate that's out there, from warehouses to storage facilities. Anything out there that's income producing, this same type of effect can happen for you. So we chose small retail and office. In early years, moved into and graduated to multifamily. In later years, we've done the single family rental home market. We buy land, build homes, and we sell them off. And I'll tell you that all of that stuff adds to your net worth. But what's cool is that you could simply go in, okay? You took a modest $150,000 worth of equity, and with $150,000 worth of equity that you have in your current single-family home, you bought 3 residences. And with $150,000 worth of equity, you turned that into $1.1 million worth of in your net worth. Okay? Now, are the homes paid off? No. Do you still have some liability on them? Yes. But I'll tell you that if you practice the payoff plan by utilizing home equity lines of credit as opposed to a traditional mortgage, in 10 years from now, you could have all 3 homes paid off. You have $1.1 million in equity, plus you have passive residual income. So in 10 years from now, you sit back and you say, okay, I'm renting for $2,000 per month times 3 homes. That's $6,000 a month times 12 months. That's $72,000 a year in passive residual income. Okay? Times 5 years. In 5 years, that's $360,000. You have appreciation of $375,000. That's $735,000 of income over the course of 5 years just off of 3 single-family homes. Now, I don't know about you guys. My mom and dad worked a full career for over 30 years, and I remember when I sat back and I talked to them about retirement, about annuities, about their stocks, their bonds, their retirements and stuff. They didn't even have close to that in regards to their retirement. And so, love my parents, intelligent, great, honest, hardworking people, which is like 99% of the U.S. population. So understand that you can go out and in 5 years, you can do something as simple as 3 single-family homes and increase your net worth by $735,000. Plus, you have $1.1 million in total, in total assets. Plus, in 5 years, you've made $735,000 through passive income just off of 3 single-family homes. Now, what if over 5 years, those grow in equity and you pull that $375,000 out and you multiply that each time? So instead of going out and just having that $150,000 exercised one time, what if in 5 years from now, you go out and you take that $375,000 and now instead of buying 3 homes, you buy 6 homes? And so over the next 5 years, you just multiply that times 2. So you go 375 times 2. Now you have $750,000 plus your original $375,000. And in 10 years, you have $1.1 million of additional equity growth. That doesn't include your entire net worth. That's just equity growth. So now you have the original 3 homes. You pulled out the equity. You bought 6 more because you have $375,000 in them. So now you have 9 homes. 9 homes at $300,000, at $250,000. You have $2.2 million in assets 10 years from now. Plus all your appreciation, plus all your growth, plus all your passive residual income. You have 9 homes renting at $2,000 per month. That's $18,000 a month times 12. That's $216,000 per year in income. Now, ladies and gentlemen, this is how the wealthy get wealthy. This is how people, the gurus in real estate, get wealthy. Because we don't look at going off and selling off our real estate. We go off and say, okay, let's pull the equity out. Let's multiply that equity. Let's reinvest it. So instead of going out and buying big fancy homes, big fancy cars, and going out on these extravagant vacations and living this extravagant lifestyle, we invest in our futures. And so we take that equity out of our properties, we go out, we reinvest it. We go out and we create a lifestyle of wealth, residual income, passive residual income, and we increase our net worth. And ladies and gentlemen, it's as simple as that. You can do it with retail, you can do it with office, you can do it with industrial warehouse space, you can do it with storage facilities, you can do it with single family homes. And you can go out and buy a lot, build a house, take that equity, and multiply it into long-term holdings and renting. So long-term, the wealthy, they hold their real estate. They don't sell their real estate. And they go out and they duplicate their passive residual income. And they create more wealth with the wealth that they initially started with. And they continue to compile that. And ladies and gentlemen, that's how you go out. You buy an asset, you get passive income, and you compound your success.